Hello, my name is Kimberly Worth, and thank you for taking the time to watch our video presentation on Conn's Inc. as part of the Burke and Road Reports program at Tulane University. The other members of my analyst team include Eric Barber, Zach Cohn, and Maxim Slove. Conn's Inc. currently operates 71 stores in Texas, Oklahoma, and Louisiana, after closing 5 stores in fiscal year 2011, and has its headquarters in Beaumont, Texas. It trades under the ticker symbol CON on the NASDAQ, with 31.88 million shares outstanding. Conn's Inc. is a specialty retailer that has 4 pillars of business that lead to profits. First, the company sells products in the categories of consumer electronics, home appliances, home and office, furniture and mattresses, and lawn and garden equipment. Conn's offers service and repairs for all products purchased from its stores. It also offers the opportunity to finance the purchases through 4 different methods: Conn's in-house credit, Rent-A-Center, GE financing, or down payment. Conn's hopes to have up to 95% of purchases financed in the future. Finally, the company has a distribution system that provides next-day delivery to nearly 93% of its customers through 5 distribution centers and 3 cross-docks. This pie chart represents the revenue distribution of each category. Home appliances represent the largest percentage of Conn's product sales, with consumer electronics close behind. In the consumer electronics market, Conn's faces the greatest competition from Walmart and Best Buy. One of the biggest drivers for the consumer electronics industry is the release of innovative technology such as bigger and thinner television screens. The current state of the economy has led to a consumer preference for in-home entertainment rather than spending money at theaters, leading to the purchase of these improved products. There are projections for a recovery and growth of about 3.5% for fiscal year 2012. Conn's faces the greatest competition in the home appliance sector from industry leaders Sears and Home Depot. The home appliances sector has struggled in large part because of the sluggish housing market and the struggling economy. There has been a slight recovery for the industry as shipments of washers and dryers, dishwashers, refrigerators, freezers, and ovens grew by 4.6% in fiscal year 2011, and estimates predict a 2 to 3% growth in fiscal year 2012. Technological innovation is also key to this industry, as energy-saving features on products have been in high demand. Conn's biggest competitor in furniture is Ashley Furniture. The furniture and mattress industry is projected to have 2.9% growth in the sector for the rest of 2011, a 4% growth for 2012, and 5.7% improvement for 2013. Furniture sales can often be linked to sales in consumer electronics, especially big screen televisions. Although sales in the industry have been down, consumer confidence seems to be improving, which will lead to increased consumer spending. In the past 5 years, Conn's has experienced a high of $31.12 per share in May 2007 and a low of $3.39 in November 2010. In the past year, the stock has had an upward trend due to improvements in the financial structure of the business and plans for growth in the future. In the DCF model, we assumed a weighted average cost of 7.76%, a risk-free rate of 2.5%, a market risk premium of 5.7%, and an adjusted beta of 1.39. Beginning in 2017, we additionally assumed a growth rate of 3% indefinitely. We incorporated the DCF because we believe that the company's forecasted cash flow will have a significant impact on the price. Using the PE method, we integrated a peer average PE ratio of 11.91 as a point of reference and used an estimated EPS of $1.58 over the next 12 months. We applied the PE valuation method because the performance of the company's peer group is representative of the average valuations within the industry. For the enterprise multiple, we used a peer average EV over EBITDA of 6.158 times as a benchmark. For the EBITDA, we used the forecasted value for fiscal year 2013. The enterprise value is calculated by using interest-bearing debt of $299.2 million and cash equivalents in the amount of $8.3 million. Conn's Inc. historically has had a significantly higher EV over EBITDA ratio than its peer group. We included this particular valuation method in order to establish a more conservative target price. We established a 12-month target price of $14. We used the weighted average of DCF, PE, and EV over EBITDA valuation methods to derive our price estimate. Our price estimate would result in a return of 28.7% over the next 12 months. Conn's has significantly outperformed the S&P 500 over the past year, We expect this trend to continue due to Conn's Inc.'s decreased leverage and improved profitability. Therefore, we have issued a market outperform designation for Conn's Inc. over the next 12 months.
Through our analysis of Conn's Inc., we have developed 4 points of our investment thesis that represent the most important aspects of the company going forward. Firstly, Conn's redesigned stores will prioritize furniture and mattress sales. The company recognizes that this division represents 15% of its net sales, but 23% of product gross profit contribution. It can place a higher price on furniture, which complements the credit division, as customers will need to finance large purchases. Furniture also complements the distribution Conn's has put in place. The company has an advantage in the delivery of heavy products and can deliver 6 days a week. Conn's has placed a focus on furniture in its stores by redesigning the stores to place these items in central floor locations. Secondly, Conn's will open new stores in target markets to drive revenue growth. In fiscal year 2012, Conn's closed 5 stores that were underperforming expectations. In fiscal year 2013, Conn's hopes to open 5 new locations near distribution centers to continue its great delivery reputation. The company is also looking at areas that have typical customers that can benefit from Conn's credit division. Possible locations include Kansas, Arkansas, New Mexico, Arizona, and Mississippi. Conn's will lease the new properties and can receive a positive return on invested capital after the first year of operations. Thirdly, flexible financing options help maintain a loyal customer base, shown by the fact that 68% of all business done in fiscal year 2012 was repeat business. Conn's generally targets middle to lower income customers, with an ideal customer having a credit score around 640. Conn's can offer credit to customers with varying credit scores with its 3 financing programs. Through Rent-A-Center, Conn's will extend rent-to-own financing options to more underqualified customers. With the use of Conn's Credit, the in-house credit option, over 50% of total sales are purchased. Conn's also renewed its partnership with GE Money to extend options to well-qualified customers with higher credit scores. Lastly, improved collection methods will help lower delinquency rates and improve cash flow. Conn's is working to improve collection on credit sales and lower its delinquency rates. Conn's enacted more stringent credit and write-off policies to strengthen its credit portfolio, and as of the second quarter of fiscal year 2012, Conn's has achieved 19 months of year-over-year improvement on cash collections. The company's balance of accounts receivable of 60 to 209 days delinquent had fallen from $52.1 million to $36.7 million from quarter 2 2010 to quarter 2 2011. This improvement is vital to Conn's success given the company's goal to finance 75% of sales in-house and an additional 20% through GE Capital and rent-to-own. Thank you for watching our presentation. For more information about Burken Road Reports and our investment report on Conn's Inc., please visit www.burkenroad.org. The Burken Road Reports are produced solely as a part of an educational program of Tulane University's A.B. Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or contact your own primary research regarding any potential investment.